And earlier on, I spoke to Stephen DeSanctis. He's an equity strategist and head of small cap strategy at Bank of America Merrill Lynch. And he talked about what's ahead for U.S. markets.
Yeah, I think with the market reacting to just economic news, really, the corporate earnings season is basically behind us. That was the positive because earnings numbers were pretty strong here in the U.S., but now the economic news has not been very good. And I think that really calls into question where we stand on earnings for the third quarter, fourth quarter, more importantly, for 2011.
And where do we stand on earnings, Steve? As you mentioned, for the earnings season, the ones that beat actually didn't get that much lift in the stock price, but the ones that disappointed really got hammered by the market. So what does that say to you about investor sentiment right now?
Boy, I don't think there's a lot of confidence out there. I think, given where stocks in general have been since really April and where small caps have been in particular, they've taken a pretty big hit here, and I think the earnings estimates, when you look out to 2011, seem awfully optimistic. Small cap and mid cap earnings growth are going to be north of 20%. If you think GDP is going to be a lot slower here in the U.S. than what's forecasted, that number is coming down. All of a sudden, the argument for stocks being cheap really kind of comes into question because the earnings numbers are going to start to evaporate here. And I think that's what you're kind of reflecting in the stock price performance.
Yes, Steve, last quarter was the second time since 2002 that small caps actually underperformed the market on average. So what is the strategy then for 2010 heading into 2011? Is it to pull your money back onto the sidelines, hold in cash, or are there still bargains to be found?
I think we've had a more cautious stance, especially in the small cap arena. I think there are plenty of opportunities out there in the U.S. market, especially in the small cap space. We've been more on to quality, which would be higher return on equity companies that are a little bit faster growing, a little less economically sensitive. I am a little bit more defensive. I think you have M&A activity picking up. I think that's going to be a trend here in the U.S. that's going to continue throughout the remainder of the year, probably into 2011. Awful lot of cash sitting on the balance sheets of companies. Again, valuations from an overall perspective, if you look at individual stocks, there's still a lot of bargains out there to be had. It's just, again, the question is really going to be what the earnings numbers are going to be. And if you're a little less cyclical, I think that's going to make some sense there. I think that's a better strategy than being more tied to U.S. economy and then also just being tied to growth rates as opposed to being, I think companies with more organic growth is going to be a better place to be.
Okay, Steve, finally, what do you think about this theory of double dip or even fears of depression?
I think our firm in general have been less on the double dip side. I think obviously growth rates are a little bit slower. GDP numbers have been coming down. I don't necessarily think that we're going to be going toward the double dip scenario here. If you look at the way stocks have responded, though, it seems like it's somewhat already built in. In a typical first half of a recession, small cap stocks are down about 10 or 11%. Large caps are down a little bit less than that. And really, since April, we've seen far worse performance than that. So I think it's kind of already been kind of into the stock performance here. Again, I think the real question is going to be what's the earnings numbers going to look like, not just the third and fourth quarter of this year, more importantly for 2011, and that really does need to be adjusted a lot lower.